Welcome. I'm Ken Kirschenbaum. Thanks for joining our webinars. These are the 2022 webinars, and Sean Iverson has the honor of doing the final webinar in this series. Sean is going to be advising you about due diligence and the role of the broker in that due diligence. He's well regarded in the industry, knowledgeable, and besides selling insurance, which is, I guess, what the due diligence really on his end is all about, it's extremely important. I must confess that I did not fully appreciate the role of the broker in the due diligence process, which is surprising when I look back at it, because when you think about it, what is the due diligence? The due diligence almost starts with review of the contracts. What's the purpose of that? Well, check on liability exposure. That's why we're looking at those contracts. And contracts that do not satisfy the liability issues generally either fetch less multiple than they should be getting, or no multiple, because some of the buyers out there simply won't even consider it. So getting contracts re-signed so that you can qualify for your insurance is sometimes an arduous task. Anyway, Sean's going to has a great presentation for you, and I'm going to turn over the presentation to him now by making him a presenter. And Sean, you are now a presenter. Click on it, and your screen will come up.
Perfect. Let's change.
You're there.
Can you see? I'm going to change my screen. Oh, so you can see my. We're good. Okay.
Okay, great.
Well, welcome everybody. You guys are excited. The topic is very intriguing, isn't it? Insurance broker contribution to due diligence and acquisition transaction. I mean, who doesn't want to attend that? That just sounds like so much fun. Well, we're going to make it fun. We're going to hopefully learn some things today and get off on the right track. One of my favorite and the downside to security business is the false alarms. And so one of my favorite cartoons is this cartoon where it's talking about false alarms, and it would be nice if the firefighters could just go straight back up the pole. So getting off on the security side, it's good. I want to talk a little bit about who we are as the insurance center, so it'll give us a little bit of credibility. We have high standards of excellence. We're a big best practice agency. There's 38,000 insurance agencies in the United States, and there's only 250 that are best practice agencies. We have been for the past 3 years and are proud of that. Experience in the industry, we have 25 years. I first got in the business in 1993, but started doing alarms a few years after that, after I got my feet wet in the insurance business. We are an independent agency. We're trusted choice. We represent multiple insurance carriers to help out your needs, and we also do a lot of reviews for mergers and acquisitions. And so recently, the mergers and acquisitions have just been going crazy. There's been a ton of them. There's more mergers and acquisitions there were more in 2021 than there had been in any other year. The time frame has shrunk down. It used to take up to a year. Now things are going quick. And so we, as the insurance advisor and broker, we want to be involved in step 3 right there in the due diligence. And so we're going to explain how and why you need to get us involved, because really, like Ken said, he goes, yeah, I didn't really understand what the importance of the insurance broker is, but I mean, it's our job to give you be a risk manager for you, to protect you. The contracts that Ken does are the best in the industry, and so those protect you, and so does the insurance policy in the event the attorneys try to get through and want to sue you. We want to talk about several policies, because in the insurance business, for the security side, there are a lot of policies that you could and should have. And so I have to do it from the webinar, meaning that there's some of you that are small, just mom and pop dealers, and then we have some that are large with hundreds of team members, installers, and multi-state. And so I'm trying to gear this to all of the above. The three policies that everybody basically has to have is the general liability, errors and omissions, or the professional liability, the workers' compensation. Then from there, now we start going into property, inland marine, commercial umbrella, commercial auto, directors and officers, EPLI, which is employment practices liability, cyber, bonding, benefits, life. And so you can see there's a lot of insurance policies that you currently should have, again, depending upon your size. During a merger and acquisition, there's actually a final policy that you can get, and we're going to discuss this. This is talking about representations and warranty coverage, and so we'll discuss that here in a little bit. We got to be prepared because the future is unknown. You don't know what you're buying until you do due diligence, and there's a lot of hidden risks out there. And so you need to make sure that you can tell the future, and that's challenging unless you are this guy. And if I remember right, I think I got this picture from law school of Ken when he was in law school, and he may have been moonlighting to pay for law school. And so I think you can kind of see a resemblance here. Actually, not at all, but Ken had to, tease you a little bit, have some fun during the insurance side, right? All right, what we're doing is we're gonna change this. Looks like you can see both my slides. We're gonna go here and how's that, Scott and Ken? Can you just see the one slide now? I want to make, now you can only see the one.
Right.
Okay,
right.
got it. Sorry about that. I wanted you to be only seeing the one because we don't want to see the Ken right off the bat. We wanted that to be a surprise. Scott came in and let me know that that was the case. So thanks. Any other issues? All is well? Okay, we're going to continue. All right, we're going to continue. Thanks for taking a little brunt of my joke there, Ken. Now, what we're looking at here, you need to consider for all those policies that we just talked about. And so there's an asset purchase or stock purchase. Which one are you doing? One's not right or one's not wrong. Most of the purchases we're seeing are asset, but just because that's the preference for a buyer typically, but you can do either. Make sure then you also need to look at your contractual liabilities. What are your existing contracts? And that's where Ken comes in, where he can be your hero. You have one of his contracts, you're set, and then you can make sure that you're in line as you're doing the mergers and acquisitions. The seller limits, are the seller limits accurate? Are they adequate for your needs? They may be smaller than you. They may have lower limits of liability. You need to make sure that they're up to speed. You want to make sure that you can look and see what their prior losses. You don't want to buy a company that is terrible from risk management with multiple losses. And so you need to be able to handle and take care of those. And so by getting loss runs for the past 5 years for all policies is going to assist you. Then you want to know, has the company you're buying, have they had any mergers or acquisitions in the last few years? Because if they have, then now you have additional exposure for that previous company. And have they changed coverages at all in the past 3 years? Not sure. Maybe they increased because they grew. Maybe their insurance advisor advised them that they needed to add some coverages. Look and see what policies have changed. Are there legacy exposures? You know, we talked about this. I've been on the webinars that Ken's done this year, and they've been great. Even the ones that's talking about yesterday, Peter Goldring. You know, I'm not in the security business, but I also want to know what's going on in the life of a security dealer, so it helps. And so, and then Kelly Bond did a great job from Graybeard. talking about, there's a disadvantage if there's been some legacy exposure. Our 3G, does your company you're buying, do they still have 3G accounts? That's not a good sign. We need to find out. Then, do you combine your policy or do you keep them separate? And so that is going to vary. And so that's why you need to get your insurance broker involved, because some you combine, some you don't. And we're going to talk a little bit about that. What about potential uninsured or underinsured risks? They exist, and so we want to make sure that we are taking care, that you're taken care of as the buyer. Now, we've also helped out sellers. Mainly we're on the buyer side, but we have helped out sellers get ready to sell. And so, get with us. We can help you in regards to that. All right, now we're going to talk about each specific policy and the differences and the challenges from the insurance that you need to be aware of. Are you on an occurrence or claims made policy? Out in the world, most E&O policies are on a claims made. However, in the security industry, it is mainly on an occurrence basis, and that's what you want. You don't want a claims made policy on your E&O unless you're forced to. And typically, when we're forced to, it means you had a lot of claims and we've got to go outside the traditional markets that we have. If you are a claims made, then you're selling or buying, you need to look at an extended reporting period. You've heard of a TEL. Well, this is what we're talking about in regards to the TEL and getting that up to speed. Now, higher limits. Are you going to need higher limits? Because now your revenue, if you're purchasing someone, if you're acquiring someone, now revenue is going to be higher. You're going to have higher exposure. And so maybe you only had the 1 million, 2 million without an umbrella. Maybe you had 5 million. Well, now with this new purchase, you may need to look at hiring those limits. And then it goes to contracts again. I can't reiterate enough the importance of your contracts in regards to liability from an insurance standpoint and a protection standpoint. Are your contracts up to date or are they outdated? Here is a perfect example. You got the caveman with, hey, this is home security and it is state of the art, but the art just has not advanced yet. And so are your contracts up to date? Are your insurance policies up to date? And so you've got to make sure that those are accurate and not in the caveman style. Work comp. This is a big issue. You want to see, along with the loss runs, you want to know what their EMOD is. And so your experience modification factor is a big deal. We can go down as low as 0.65, so you can get a 35% discount off of the average, and we've seen it as high as 2.25, maybe even 2.5, where it's 2.5 times what the average is. And so you don't want to purchase a company that has a high experience modification factor. Are the employees, the current employees, properly classified? Are the salespeople classified as salespeople, installers, clerical? Are they all properly classified? Then what's the employment law? Are you going into a new area, a new state? How is that going to affect your work comp? And so those are important questions to ask. And then OSHA citations. Does the company you're going to buy, are there OSHA citations? All right, property and inland marine. Inland marine's a crazy terminology. It basically means property that moves around. That's your tools, equipment, things that are on your trucks, and then property. Know what is being purchased. We've seen some companies that have purchased and they thought they purchased certain things, or they didn't know that they purchased certain property. And so make sure that you know the property that you are purchasing. Equipment, is there any equipment? What about inventory? Intellectual, patents, trade secrets, copyrights, trade names, web pages, phone numbers, all of those, make sure that they're all there. Licenses, accounts, your contracts, statement of values. What are the values of everything that you're buying? That should be in there. That's a given, but the broker will need to know of the new statement of values. for the new entity. Is your company located in a flood, a hurricane, a tornado, a wildfire, an earthquake? That's going to matter from a pricing standpoint and from a coverage standpoint. Make sure you have the proper, you know what it is. Then also your leads, your leases, your deeds, your mortgages, restrictions affecting property. These all make a difference because there can be requirements, there can be restrictions based off of those contracts that you have. Then finally, in regards to property, is there going to be some international exposure? You're purchasing a company that does business outside the US. Well, if you didn't previously, you need to make sure your broker's aware so that we get that covered. And so it is definitely possible. The excess policy. We've seen a ton of issues on this where the policy, where they thought the umbrella policy went over all of their policies. So an umbrella you have underlying policies and the umbrella goes over top and gives you excess limits. And so what's happened here, we've found, is that I think all of the time it covers over the general liability, but we've seen many times where the professional or the E&O, the excess does not cover the professional. And so it does not go over the professional. So you may only have 1 million, 2 million limits of professional liability. You may have a $5 million or $10 million excess, but it doesn't go over the professional. You need to make sure, know what you know so you can price it accordingly. Your work comp, employer's liability, it can go over that, and most of the time when we write an excess policy, we want it to go over that, but we've seen where the policies have not gone over that. And then also commercial auto. The commercial auto is a big exposure, especially if there's a serious accident to death. Then you want to make sure that you have the adequate coverage, that your umbrella is going to cover those items. And there could be other policies as well that the excess goes over, but those are the 4 typical policies that it should go over. Now let's talk about the commercial auto. Your fleet policy, you may have a complete different philosophy and policy than the current owner of the seller that you're purchasing. So you need to put those two together. Look at the MVRs of the drivers. You may be taking on people that installers that have DUIs, reckless drivings, manslaughter. I don't know, but you need to make sure that you get those prior to or during the due diligence process so that if there are, you can account for those bad driving records. Typically, we like to see a driver acceptability matrix, and so we have one available if any of you need one. The policies and procedures, how do you differ from the seller? Do you allow cell phone usage? What about distracted driving, telematics, GPS, dash-mounted cameras, in-cab cameras? A lot of times we're seeing the in-cab cameras come into play so you can see if the driver was distracted or not. Well, the new company, the employees might freak out and I'll quit because of your policy with in-cab cameras. Make sure that your policies align. What about personal use of business vehicles or business use of personal vehicles? Maybe you're a small company and you don't own any vehicles and you force your employees to drive their own. What kind of exposure do you have? And so these are some of the things that you need to take into account in regards to the commercial auto. We always recommend training courses. We have some available on video and also written that they can use their cell phones and do it. And so there's a lot of things that we can do to help you and your client, or you and the seller, the company you're going to buy, take care of insurance needs. All right, the D&O, directors and officers. This is unique in regards to mergers and acquisitions. It's probably the most unique. Some of the other policies may have these issues, but the D&O, most of them are a claims made policy. And we'll go in, that's a whole nother webinar in and of itself, the difference between an occurrence and claims made. Just realize that if you have a claims made policy, you, the buyer or the seller, one of you need to purchase a tail coverage to protect you for future notices of claims that took place in the past. And so it's called a tail coverage or an ERP. And so we need to make sure that you have that, determine who pays for that extended reporting period, ERP, not ERC. Change in control. And so every D&O policy that we've read, and so there's multiple different variations of the D&O policies that they all have a change in control clause. And so as soon as there is a change of ownership, then the policy is basically dissolved. And so you have to get a tail coverage, you have to get a new policy. And so for that reason, we've seen most of the D&O policies go with the buyer's policy. EPLI, this is a big one when you're dealing with employees. Is there any current litigation going on with the seller company? You know, employees sometimes fight and they're disgruntled, they have issues, and so maybe there's a current litigation. You need to find out. Then on the employee, you want to see and get your employee handbooks, your manuals, contracts, policies and procedures, and benefit packages all in line with each other so that you try to eliminate disgruntled employees. And so it's a challenge because when you're purchasing a company, the new company, the selling company, all the employees are a little apprehensive. They're scared. They don't know what to expect. It's a new thing for them. They've been happy with status quo, and now what changes are you, the buyer, going to come in and make? And so the employment practice liability policy we've seen pay out during or right after mergers and acquisitions because of the employees. You can the organizational chart, the restructuring is also important because they want to know where they're going to fit in. How do they fit in? Where are they going to fit in? And so the better communication you have, I know that's not really good in regards to insurance, but the better communication you have with the employees of the selling company, and you're walking on eggshells because most of the time the seller doesn't want to disclose that to the employees because they don't want to jump ship. And so once they get notice, the new owner needs to go in and help everybody relax because there's a lot of apprehension there. And as we know, we're a sue happy society. You can sue anybody for anything. And here is the last Attorneys Association. I think Ken attended this a couple months ago, and a guy that he was given a business card to got a paper cut, and he goes, "I'm going to sue you." Anyway, the point of it is we can sue anybody for anything, and so we need to make sure that we're dotting our I's and crossing our T's with contracts and talking with our insurance broker so he or she can advise. All right, there's a few other policies we want to discuss. Cyber liability. We've kind of been going through these really quickly. We can go, if you have questions after, we can discuss them, but I wanted to get through them so that you can see that there's a lot to do and that your broker is going to play an intricate role as you're going through the merger and acquisition, so the due diligence. Companies, you're most vulnerable during this merger and acquisition. You're disclosing data back and forth. The employees are trying to work things out between the IT departments, and it is a challenging time. Data transfers, make sure you're backed up prior to doing all the transfers. Get a continuity plan for a disaster. What's going to happen if while you're transferring the data, the power goes out? What are you going to do? Have continuity plans available for the unexpected, because that's really what it is. You want to train the employees, both of the buyer and the seller, to make sure that they're understanding and being watchful of possible cyber breaches. cyber, any issues dealing with data is important. Ensure the systems configurations are all up to date. I mean, that sounds simple, but that we've seen where they haven't been, and there's been a breach because they had a patch that they should have done and they didn't. Here's one, prepare protective monitoring procedures for possible disgruntled employees. You know, an employee might be ticked off that the owner sold out, and they may try to ransack something. And so just be on the lookout, have something ready to go, and prepared for that disgruntled employee. Hopefully it doesn't happen, but it could. But you got to be aware the cyber attacks are ahead. They are coming. They're coming fast and furious. You know, with the war going on, Russia and Ukraine. Well, what's Russia going to do with the United States? Are they going to put a cyber attack on us? Are they going to shut down this system? Are they going to shut down our grid system? What's going to happen? Well, we don't know. But you should have a good cyber liability policy and be prepared during an M&A. Bonding issues. There are some bonding issues you need to be aware of. The licensing and permit bonds, several cities, states, counties will require you to have license and permit bonds depending upon the state or where you're working, where you're doing the security business. I'm sure most of you are aware of what those are, but if you're purchasing one and you're changing the name, you need to make sure that there's the license and permit bond are changed. You also have payment performance bonds. We don't see a lot of that in the security industry, except for when you're working on federal and state buildings. And then oftentimes they're requiring you to have payment and performance bonds. When you're purchasing a seller, does that person or does that company have any existing bonds right now? Do they have any payment performance bonds that they haven't fulfilled? You need to double check that. And with the merger or acquisition, is that going to sustain, decrease, or improve the bonding capacity? And so your bonding capacity is the amount that you can bond for on those payment performance bonds. And so it can affect you, especially if you're taking a large loan out to purchase. Your debt to ratio is not as good, and so that may affect your bonding capacity. If that is something you do, you need to be aware of that. And then will bonding contractors continue or change if ownership happens? Don't know. You need to double check on that. Now, benefits. This is unique. If are you going to take on the seller's health insurance policies? They're going to be deductible carryovers, if so, because the employees are not going to be happy if they've already met a medical deductible of $5,000 and now they get a new policy where the deductible is not carried over. And so just check on your health insurance policies. Same with 401ks and ERISA bonds. Is there an asset transfer there? Or do you need to increase your ERISA bond for the 401k? And are your contribution levels into the 401k, are they the same between the two companies? And we need to get those the same. What about key person life insurance? Is this needed? Do we need to purchase it for the prior owner of, or the owner of the selling company? Or because of lending requirements, do we need to purchase a new life insurance or key man for the buyer's owner, because now they have a large loan? And so there could be lender requirements in regards to key man and life insurance. Here, you may need to purchase on a key employee. Maybe you're purchasing a company and they have outstanding team members, their executive team, and you don't want them to leave. And so they can be a golden handcuff by purchasing a permanent life insurance product where the executive will keep it over time and they'll keep the cash value. And so it is golden handcuffs, and that is an option for key employees or key executives that you want to retain for the new company. All right, that's all the insurance policies that you probably have currently. There is another one that we want to discuss, representation and warranties insurance. What this does is it protects the buyer and could protect the seller against inaccuracies of unknown and unforeseen risks. This is a policy that is purchased right before and right at the time of acquisition. Typically, this is an expensive policy, but it can benefit you and the seller in many ways. We typically find the representation warranties policy, if the deal is under 30 million, then it's not cost effective and it doesn't make sense to do this. If the deal is north of 30 to 50 million, it's kind of a coin toss. Yes, yes, no, it just depends. And if the deal's over 50 million, we recommend this purchase because it helps the buyer. It extends the representation warranty time after purchase. And so, you know, again, as we mentioned earlier, that time period of our M&A is such on a short time frame now that we've got to do it quick. Everyone wants it done quicker. And so this will enable more discovery time, basically. It removes a little bit of the worry of collecting on the seller's promise. It speeds up the business sale of covering future liability or future representation. And so what that means is a lot of times maybe the owner of the security dealer or the monitoring company, maybe the owner passes away and it's a fire sale because nobody wants it in the company, and so they have to sell it quick. And so this can speed up that sale, and it also enhances your buyer's bid if it's a competitive auction. So if there's multiple people putting in, and if you have an RWI, then it's going to benefit you. You're going to have a leg up on the other bids that are out there because it kind of provides a seller a clean exit. And so it makes it so they can walk if they want to, and they don't have to stick around and try to earn any earnouts that are requested. And so it's a great policy. It has a great fit, but again, it's typically on 50 mil and higher, and it preserves some key relationships. Bottom line, went through a lot, went through it really quickly. I know I didn't want to take a full hour of your time, and so bottom line is, hey, don't hide anything from your insurance broker. You know, we're your friend. We're here to help. We don't want to have an issue at time of claim. And so this poor turtle apparently has a claim on his homeowner's policy, and the adjuster saying, well, you didn't disclose that it was a mobile home. And so his shell, I guess, is what they're going at. We want to make sure that we don't have any issues during the merger and acquisition time period and after. And so inform your broker of all the details. We're here to help. We're on your side. And so we're going to tell you, good or bad, what the best solution will be. With that being said, we want to offer you, we do have a merger and acquisition toolkit. It's 34 pages. Anyone that is on this webinar and you email me today, Sean at alarminsurancecenter.com. We'll get this we'll get this sent out to you. It's a great kit. It has 10 pages of a checklist, has a human resource checklist, has an insurance checklist, has a buyer's checklist, kind of gives you more details on many of the things that we discussed today. So send me an email. We'll get that out to you. And if any of you are going down to ISC West, happy Scott and I here from the Insurance Center will be there, and love to meet with you. I think we have a presentation sometime during that week. Feel free to stop by and hear us. Send me an email if you're going to be there. Love to get with you and meet and discuss any other merger and acquisition questions that you may have. And with that, Ken, there is a really quick, really fast breakdown of the due diligence that an insurance agent should do in your behalf as a dealer monitoring center. We've done a ton of deals in the security side for mergers and acquisitions, and so we're familiar with it. Are happy to help. Any
Thanks.
questions, Ken?
Sean,
Any comments?
Sean, I'm going to put you on the hot seat in just a second.
Yep.
I want to thank you first. That was a quick presentation with a lot of information, very informative and entertaining. Let me tell you what's important about involving the insurance broker in your due diligence process. And I must say that I'm going to tell you that these are things that I'm thinking about now almost for the first time. Claims history. Why is that important to you if you're an asset purchase deal? You're not
Well,
taking on any liabilities. Well, you're not taking on any liabilities of the seller. Why do you care about the claims history?
history repeats itself.
Well, that's right. Also, the same with if you are taking on any employees, it might be interesting to find out whether the employee has a history of unemployment, has a history of disability, has a history of maybe suing his employer if it's been covered by insurance. There might be a lot of things you might want to find out, and the seller's insurance broker, if given authority to share the information, might have quite a bit of information for you in terms of what went on. The claims history is particularly important. Why? Not because you are liable for losses arising prior to the closing of your transaction, but because if you have a seller with multiple claims against them, you have to think that those types of claims are going to continue after the purchase. You would be naive to think that you're going to do things so much better than the seller did, that you're not going to wind up with the same claims experience that the seller had. Now, so I want to make that clear, and that you get that information from the insurance broker, okay?
But it has to be done. The seller has to request it. The buyer could not request it. It has to be done. The seller has to request it from their broker because that's where the relationship is.
Okay, and what exactly are they what exactly is the buyer demanding of the seller to request? A claims report?
It's called 5-year loss runs, and so that's what they're requesting is a 5-year loss run.
Okay, and so that would entail liability cases, and what about for employee claims and things like that?
You want it for all policies that the seller has, and so you request a 5-year loss run for every policy that the seller has.
Okay, I'm going to jump to a third issue I have, and then I'm going to get back to the second, which is important. The reps and warranty policy. That's an interesting policy. I did have a deal where the buyer asked for that. I struck it because I wasn't going to have the seller pay for it. I represented the seller. I wasn't going to have the seller pay for it without even knowing what was involved in that. But you raise a very interesting issue here, because most deals are not 30 million or more, and very few deals are 50 million or more. And when they are around those numbers, the due diligence involved in those cases often involve a lot of time. And of course, probably they know about involving brokers at that point also. But if they don't, they should. But can you give me an idea? Two issues come up with this, what you call the RWI policy, reps warranty policy. One, give me a rough idea of cost. Is it based somewhat on the sale price of the deal?
It is. And so typically you don't insure the entire deal. You typically insure about 10% of the deal. So let's say it is a $50 million deal. And so you're only going to insure 10% of that because you know that the whole thing's not going to go south on you. And so you're only going to insure 5 million of the 50 million. And so a typical price is somewhere between 2 and 3% of that purchase amount. So if you're talking 5 million, now you're talking 2 to 3%, you're talking 150,000 bucks.
Right. So 5 million would be $150,000. And for that 150,000 on your $50 million deal, you've purchased yourself $5 million worth of coverage.
Correct.
Okay. And what exactly is covered? So what's covered is, now I'm going to tell you, every asset purchase deal, the stock purchase deals are even more extensive than what I'm going to tell you now. But the asset purchase deals all have boilerplate standards, standard representations and warranties. There's loads of them, loads of them. And they're very often glossed over. There's representations that, of course, that the seller owns the property that they're about to sell, that there's no impediments to the sale. There's no judgments or liens or court orders preventing the sale. The assets are free and clear. There's no outstanding claims. There's no outstanding request for service. There's everything is peachy, clean, and ready to go. That's the representations that's made. And more often than not, most of the time, if not all of the time, there is no indemnity fund to guarantee those representations. Keep in mind that the holdback, which you're all familiar with, is collateral for the attrition guarantee. It is not typically also a guarantee, a fund that can be used to collateralize the reps and warranties in a deal. If you want collateral for your reps and warranties, you might need a separate holdback if you can get it, or you might need reps and warranty policy if you can get it. Now, interestingly enough, what happens if you have, let's call it a more typical deal,
Okay.
$1 million deal. It's just $1 million deal. That's all it is. Can I get $100,000 reps and warranties coverage?
Nope, because most of the time they have minimum premiums. And so there's a lot of due diligence that the insurance company does on their side. And so you're going to have a minimum premium of typically 150,000. And so that's why I say that caveat is that 30 million is questionable. The 50 million is right there in the sweet spot. Anything above, we highly recommend, because if you're going to pay $100 million, what's $300,000 or $400,000 additional to give you the security for any unforeseen reps or warranties that weren't disclosed properly? And so it's a great deal.
Now,
but it is for the bigger accounts.
Not that I'm expecting any 50 million deals to walk in my door today. Let me ask you this. How long will this type of insurance delay a transaction? I'm sure the insurance company probably engages in its own reps and warranties, or relies heavily on guarantees from deep pockets, whether they are the seller who's got a deep pocket, or more often than not, I'm willing to bet, the seller's lawyers that have deep pockets, who are going to have to render opinion letters in order for this insurance to be issued. Not to mention reps from an insurance broker, the accountant, everybody else. I'm sure, my guess is that the insurance company is going to lock up all the sellers' principals and all the sellers' professionals before it issues this kind of a policy.
It does. And so, you're correct. And so the fastest we've ever seen it happen was 2 weeks. That's unbelievable. And so, but the typical time to have this policy from the time that we say, look, we want to do it, until the time that it's ready to go, is about a month.
Okay. Now,
so it's not terrible.
Here's my last issue for you. This comes up quite a bit. I am fairly adamant about it. I'm going to give you my position before I ask you yours, so you
Okay.
know where we're going.
So I know I tread lightly.
Okay, well, we get involved in deals.
Mhm.
Sometimes I represent the seller, sometimes I represent the buyer, sometimes I represent both. And a buyer may demand that a seller continue their E&O coverage after the sale. They want them to pay for 3 years, 2 years, whatever the period is after the closing. My position has always been it is unnecessary for a seller to continue its insurance after the closing. Why? Because after the closing, the buyer takes over responsibility for those accounts as of the closing date, period. So if there is a loss, because it's occurrence policy, you didn't explain that, I don't believe, but it's, I think people know what it is. If the occurrence arises after the closing, it's the buyer's problem, and it's the buyer's insurance company's problem. So when I do a deal, I insist that the buyer actually name the seller as an additional insured in case the seller gets dragged in to a post-closing claim. Because if the seller has allowed his insurance to lapse or canceled it, the seller's not going to have any insurance coverage for that defense. It must rely on the indemnity from the buyer as well as backed up by the insurance that the buyer maintains. That's been my position. Do you see any issue with that?
No, and so just one little minute uh, discrepancy on it, and so that is as long as it is an occurrence basis policy, and so from the general liability errors and omissions, those in the security industry, they're 99% of the time they are occurrence, and so yes, everything you said is accurate. But for the D&O, for some cyber, for some other policies, they should purchase an extended reporting period because it is a claims made policy. Then the second thing is you said that add them as an additional insured. Better yet, they should be named as a named insured because now if they're taking on that name, they should be listed as a named insured on the new policy instead of an additional insured.
When you say a named insured, don't forget the seller is probably closing up its business at that point,
Okay,
usually.
and so as long as they don't continue the name, and so sometimes when we've seen the purchase that they continue on that name and it still does business as, and so if it's still doing business as, they need to be listed as a named insured. If they're closing the doors and bringing in, so it was ABC is purchasing XYZ and XYZ is going away, then XYZ could just be listed as an additional insured, but it's still not a problem to name them as a named insured for a
Named,
while.
named insured. Okay. Okay. And I do want to ask something else about that with the naming of the additional insured. Oh, when the seller closes, can they cancel their policy as of the closing date? I've generally recommended clients to let the policy run out because I'm
Yeah,
concerned about affecting coverage if they cancel prior to the end of the policy period. Does it affect their coverage up until the date of cancellation?
no,
No. Okay.
but it's not a bad thing just to let it run out. I mean, if it's a $150,000 policy, then maybe they want to consider, yeah, let's get a refund back. But there are certain when you cancel a policy, there can be a short rate or a flat rate penalty or a prorated penalty on a canceled policy, and so they may be charged money to cancel. And so I think what you're doing is you're advising on the safe side. And so anytime when we're dealing with risk management, it's better to be safe than sorry.
Right. So let it run out.
Let it
Okay.
run out.
All right. Well, I don't know if I have any other questions here. Let's see. Those were my questions. Um, they want to know if you are authorized to sell insurance in New York.
Yes,
All right.
we're
And
licensed in all states, all
okay.
50 states, including Alaska, Hawaii as well.
And he's located in Utah, correct?
Correct.
That's where you are now? Okay.
Mhm. But you'll see me at ISC West, you'll see me at ESX, you'll see me at a lot of ESA events, MAMA events. You'll see us around.
And Sean is going to be doing a short presentation, as I believe I am, at let's see,
ISC West.
ISC West at the not just at ISC West, but at the booth of
Avant-Garde Monitoring Center.
Avant-Garde, right?
Mhm.
At
Correct.
Avant-Garde, right?
Mhm.
Okay, so we're gonna see. Hopefully, we'll see you there. Maybe I'll be
Yeah.
there when Sean is. I'll heckle him. I got to get even for this webinar, and we'll see. Anyway, I want to thank everybody for joining us, and we'll see you at the next series of webinars. Thanks again, Sean.
You betcha. See everybody. Thanks, Ken.